I would now like to introduce the next panel. This panel will focus on impact investing in emerging markets, which is investing with the purpose of generating a net positive societal benefit in countries classified as emerging markets. The positive externalities yielded by this process can benefit approximately 6 billion people, or 85% of the world's population. To moderate the panel, I would like to invite Dean Karolyi again.
Thank you very much, Mumuksha.
Yeah.
So we have our panelists already here. We were originally scheduled for 90 minutes, but we're only going to do an hour so we can get back on time. And I am so pleased to have these individuals. You can read about their full bios, but we have Momina Aijazuddin from the IFC, and she is in charge of their microfinance unit, and is, like Piotr, also from the IFC, a different division, very much ensconced in the very issues of impact investing. Impact investing, according to the formal definition, is investments that go beyond just a financial return, that also has goals beyond for the natural environment and for social issues that go beyond. That's really what the foundational issue is, and so core to the theme of this conference. We also have Helen, who is from Ogilvy and Mather. She is the vice president of the global China practice, and she's involved in a lot of the outbound activity and guiding the outbound activity for China, and facing up to a lot of these issues as well. And finally, of course, our friend returning again, also like Helen and like Momina, we have Yuqiang Xiao, who is the chairman of ICBC, Industrial Commercial Bank of China, in the US, and has many responsibilities as a result of all of this, and is also facing up to many of the issues. So I'm going to lead with a question. We've already pre-planned what the question is, so they already know, and it's really I think the most obvious question is, why is, in your respective organizations, we'll start with you, Momina, why is this concept of impact investing so important and right now?
Thank you, Dean Karolyi, and it's a pleasure to be here. I wish the students were here. I'm hoping that they can access this on the bus. So from IFC's perspective, as my colleague Piotr mentioned, IFC is more than an investor and advisor. I mean, we really try and shape standards, and we bring key players together in terms of around shared goals. So in the environmental space, whether it's governance or certain like knowledge and approaches. So impact investment, as you know, has really scaled up in the last few years, and unprecedented levels also because of COVID. I think it's important now, particularly because of the increased emphasis on these global issues of our time, as you mentioned: gender, climate change, racial inequality, and the market is also seeing a level of maturity compared to pre-pandemic levels. So why does it matter? I think the increased attention towards these issues also means that companies are paying more attention to these issues. And the data that we're seeing at IFC is that companies who do better in ESG also perform better financially. So it's not just about being profitable. It's also about making sure that you're able to do well. And doing well means much more than just being making money. And I think that contributes very much towards the long-term sustainability of what we're doing. I think the bigger challenge really is, okay, you have the intent to do well. How do you go about then doing that, and how do you go about measuring it? And I think some of the issues that we've been working on is having impact principles that were set into place in 2019. And those were intended really to have a common approach in the industry. There are $1.2 trillion of assets under impact investment. The IFC, has over like 150 signatories in this space now, really to see from the smallest microfinance institution in, in a small market to some of the largest impact investment funds, so that they should have a common approach, not only in terms of what they want to do in this space, but how they measure it, and what the intent will be afterwards. So these impact principles, I mean, we'll share them online. I don't want to go into too much detail at the moment. What's been really interesting is the huge feedback from the industry. You know, a lot of interest, people signing on, working with us in terms of, you know, like implementing or operationalizing these principles. And I think, you know, I mean, it really then creates this level playing field by which companies can invest. I think, you know, some of what was mentioned in the previous panel, like whether it's green bonds or sustainability bonds, or even some of the work that we're doing on the microfinance side on gender, or you know, like reaching more poor people. It's fine to have the intent to reach more poor people, but how do you measure that? You know, what is poor in a context? You know, a poor person in India may be very different from a poor person in Brazil. Even on the microfinance side, I mean, I sit on a fund, on the board of a fund which has, you know, $800 million in assets. And one of the live discussions we're going through at the moment is, okay, 80% of who we reach are women. Is that good enough? I mean, considering that a lot of the large microfinance or banks in India already reach a lot of women, you know, should that be the bar? Maybe we should be looking at the delta or the increase. I mean, reaching perhaps more women in the Middle East may be a more aspirational target for us than reaching more women in India. So these are some of the like live discussions that were happening. And I think part of why it's important is because we need to have credibility in this space. You know, Piotr and others, Gautam mentioned about greenwashing. I mean, we've had the same in the gender movement about pinkwashing. And, you know, here we'll also face that, you know, that issue of like, do we have credibility? The only way we do have credibility is being able to measure some of this impact and to have the data which can support. And I think that goes full circle to back to what Lourdes and Anne were talking about. It is really important to have that kind of data to be able to assess the impact of what we're doing.
Yeah, it's a great summary. And I love the way you're connecting the things that we were talking about earlier. And I'm hearing the same message from Piotr about the challenges of the noise, the chaos that he described in all of these guidelines that we want. Before we go to Helen, you're next. I want to introduce another important panelist that I forgot to mention off the top, who is Mark Mobius. You see him right there. You're going to go last, Mark, and I can't tell you how thrilled we are to have you here. Mark Mobius is, of course, the principal and general partner of Mark Mobius Capital, his new firm as of 3 years ago. But for those of you who don't know, and I don't know how you wouldn't know, our dear Mark Mobius, now an advisory council member of the Emerging Markets Institute, is one of the greatest legendary investors in the emerging market space over the last 5 decades. 4 decades? 5 decades? I don't want to say which way, Mark, but one of my heroes. And I'm so thrilled that you're involved. And so if you don't mind waiting patiently for Helen and Yuqiang to go first, Mark, then we'll have you come at the end. His whole firm is devoted to this concept of impact investing. This is a pivot all the way for his new firm. So Helen,
thank you.
Why so important and why now?
Thank you. Thank you very much. I feel very honored to join this annual conference again and to exchange opinions with the experts in different industries. Let me talk about Ogilvy first, who I work for. We are one of the global leading agencies on marketing and brand building activities with office across 80 countries. So emerging market is one of the strong growth engine for my company. So why I mention that? Because impact investing, ESG, is not new in the people working in this industry at all. And it's always been built into the marketing strategy for our clients, different brands and the business, from the marketing strategy and the brand building activities. Why it's important? for the companies, for the business, for the brands, is because the following reasons from my personal opinion. First of all, because nowadays the clients and the consumers have more channels to directly interact with brands. So when they evaluate the brand, they tend to purchase the products from the brand to share the same value with them. So more and more clients like ESG, the investment the brand's doing. So when they evaluate, when they make the purchasing decision, they will put the ESG activities offered by brands as one of the key components when they make a decision for purchase your product or to be a loyal customer to you. The second reason, nowadays, these global multinational firms are more people-centric than before. Before, it's more like a revenue driven, but now it's more people-centric. So ESG, doing good things, ESG investment, actually is a demand, natural demand from its all stakeholders, like shareholders, their board members, their customers, or even their own employees. So they are waiting as a group to put more energy and resources into ESG investment. The third reason I feel is that because advanced technology, because it's easy to say than do, right? So for example, so advanced technology can help many brands to lower the cost using recycled products. For example, Nike is our client. And then there are leaders like Nike, Adidas, are top leaders in sportswear brands. And then both of them announced a commitment to produce their sportswear in next 5 to 10 years using 80% of the recycled material, such as plastic. So how can you lower the cost dramatically using recycled products? That's the question. They still need to make profit. So advanced technology help them to achieve this goal. So then they can fulfill their commitment. So from my work experience and also overview of our clients, I feel all these three reasons contribute. It's already important for them, and it's going to be more important in the future.
Yeah.
Thank you.
That's a fantastic summary because it tells you the picture, which is the demand-driven forces at work that are putting pressures, and you're channeling those pressures to the corporates that you're advising and guiding in this whole global capital market space. Well, Yuqiang, you're involved with one of the big four in China, the big four banks in China, one of the largest banks in the world. This must be on your agenda. It must be forefront on your agenda right now. So tell us how you're involved and some of the pressures you're feeling as a result.
Sure. I did not want to, for sake of the time, it's definitely a pleasure to be here, but I do not want to repeat what my panel partner side is pretty good already highlighted why those investment or the timing are crucially important right now. But I do want to share with you some of the story that I had, the why it's important for everybody. I work for ICBC many years in overseas already. I worked in a few years ago in Paris, and I get an annual meeting every winter back to Beijing. Well, that's about 2010 or 2011 something. When I got back to Beijing and from Paris and down to Beijing, I thought, looking at the sky, I thought, wow, that's barely see the moon. And then was the colors all right? I believe 10 years ago, if you're in Beijing, you may have that impression. So why it's important? Definitely important to everybody. So how long we used to have this sky, and how long it takes over there to have that moon? 3 years. And how long it got killed? How long it's getting better? Not until now. It's already better, not like this, but it's still working on it. So this is important to everybody. And I do want to respond to the why banks are important, because ICBC is a leading partner in the world in that we were a partner of IFC, UN, that we work a lot together. The why banks are important. I want to highlight a point that banks are critically important in the ESG concept, especially in the emerging market. Why? because in the majority of the emerging market, the banks is the dominating financial provider. And unlike in the United States or UK, that you see a lot of investor, asset manager, capital market, they're showing their powers and together with the banks. But in the emerging market, in case of the China, banks dominate over 90% of the finance in the whole market. So in that case, if the bank do not take the concept, do not take that responsibility, it will be very hard for everybody to move the needle, right? So because you're important and you're leveraging everything, and there's a lot of progress that has been made since then, definitely. I joined the FIF discussion. I do share a lot of those IFC mentioned. This used to be the problem that we have, and we're pushing forward with that. For example, 5 years ago, when I joined a panel in the IFF, one question from the audience is basically why we need label green bond. Why? What's the benefit to label ourselves? Even though we're green, why we need to label that? Why we need to let everybody know we're green, right? Or what's the benefit in that? So now you see those curves that we have a lot of the green bond insurance in those few years. Why? Because we're giving the benefits to those issuers. We're pushing them that you can go green and you can move forward with the benefit with the support of the banks, investors, and the government, right? So the government really need to be very responsible for those concepts. So that's why we're moving it very hard, but gradually, but we're making the progress right now. And the last point I want to make is that it's definitely a kind of the job that the bank cannot take the lead like always. It should be the commitment from the government, and it should be, the awareness for all the, everybody, all the corporates and individuals, and it should be, collective effort from all the investor and banking. So those were crucial things. I'll be very happy to take any question later on, how we move it, because along with this journey, I do saw a lot of difficulties, and even to now, it's already been a little bit too late. But I think that making progress is more important.
Well, hold on to those thoughts, Yuqiang. Excellent comments. Hold on to the thoughts about the difficulties, because we're going to come back to that. Each of us are going to talk about some of the headwinds, the challenges that we're all facing. But first, we go next to Mark Mobius. And Mark, I said the name of the firm wrong. It's Mobius Capital Partners. My apologies.
That's right.
Mark, this is everything about this new firm, right? This is everything to you. So we would love to hear your thoughts on why this is so important for you and why now.
Thank you very much for having me. 3 years ago, we started this firm with the idea of having a very specialized fund, which would have a limited number of holdings, but would focus on engaging with the managements of the companies. So it was an idea to get an impact from our own engagement with these companies. And over the years, from the very beginning, we started in emerging markets in 1987, we had to look at risk factors such as environment. For example, if we had a mining company, if the mining company had its tailings polluting the environment, that was a risk. If they were not doing well in friendliness towards the social scene, whether the community in the area where the factories were located were not happy about their being in the region, then that would be a risk. And then finally, on the environmental and social and governance side, the governance is the most important, because if you don't have good governance, you're going to have problems. So we decided that with our new fund, we would focus on these things, which are now called ESG, thankfully. But before we weren't calling them ESG, we were calling them risk factors. And in addition to the ESG, we added the C, the culture. And as you know, you've written a book on culture and the importance of culture in investment. So that's something we've added, because the internal culture of the company is critical. And one of the things we found is that when a company is engaging in ESG activities, in other words, improving their ESG credentials, the staff like it. They begin to have a very good feeling about the company. So that's another added benefit that we see in these companies. But what we do is when we sit down with a company, of course, after we've looked at the financials and we're satisfied with those, we ask the company management, look, are you willing to engage with us to work on ESG plus C to improve these factors? And we are really very pleasantly surprised to learn that most companies are willing to engage, to improve, because they now realize that this is very important to the success of their company. And of course, we've seen it in the profitability of companies. Companies that have good behavior in terms of ESG plus C, the stock price does very, very well. So it's been, for us, a win-win situation with our fund. We've had the benefit of, doing some good in terms of improving ESG plus C, but also the appreciation of the stock prices of the companies we own had done quite well. So I think going forward, you're going to see more and more of the investment community engaging and becoming more active with companies and having an impact on how they behave.
Yeah, that's a great summary, Mark. Thank you very much. And we'll come back to you. Thank you for the shout out to my own work on culture. And it's just and what we're talking about here is national culture as a defining characteristic that drives investment flows around the world. This is my own work on earlier. But the fact that your firm is actually empowering this whole concept of culture as a defining characteristic that guides some of the investments that you're making is fascinating. And it actually plays back into Helen's question about her comment about tastes and preferences of the investing public, which is him, that is deriving through the advisory roles that you play to the corporates in guiding them. So I promised we would go around to each person. We talked about this beforehand, so don't think I'm putting them on the spot. Which is this all sounds very good, but inevitably we run into issues of shortfall where things don't quite go right. There's a miscommunication or a misunderstanding about these issues. And so, Momina, why don't you start and just sort of from the IFC perspective, where you're co-investing in a lot of important deals, where you see or have seen, you don't need to say names of specific deals, but where you might have seen something in this space not quite go right, something go wrong, because it's something from which all of us can learn, right?
Yeah, thank you. And a shout out to Mark because he is also on the advisory council for IFC and has been instrumental in shaping some of the discussions on this space. I think, more than a failure, actually looking at Piotr reminds me of a project we were doing in China, which was a large scale privatization of an institution, one of the last banks to be privatized. And they reached, 500 million clients. It's a very complex institution. They serve, the reason that we were there was because we were trying to help them serve rural areas better. And this really brought home to me. I was leading the privatization work from the IFC side, but we were also there as an advisor to help them prepare for an IPO and get their ESG standards up to scratch, right, for international standards. And, part of this was just the influencing and measurement. We were a very small investor, but we were there clearly as a knowledge provider and advisor to help the bank's management. And though at the shareholder, it was a fascinating experience because we were at the shareholder level having these conversations with other shareholders about the need to do this, but the devil really was in implementation. Mm-hmm. So, I found myself, with Piotr and many other colleagues, there was a huge team of us from having those discussions in Beijing at the board level, where everybody agreed to this in theory, to the shareholder discussions where it was very much like, how do you earn commercial financial returns, but also the costs of implementing a thing like this where you have hundreds of thousands of branches, particularly in rural areas. The complexity of reaching infrastructure projects in China, which are very large scale, versus like a pig farmer in Wuhan province, right?
Right.
And the ESG standards in Wuhan province are very different from even the ones in the capital. So just being able to understand the different dynamics of even the differences within a country, right? Because each province is like a country. And just to give you an idea of scale, a village in China is 2 million people. So, just the ability for them to work in 70,000 branches through these villages, but the scale was much higher. And so this really gave us, it wasn't a failure. I mean, we've come out of it very successful. The bank IPO'd, but part of it was just being able to understand the complexity of what was going on at the board level, the ability to explain in the simplest terms, the ESG requirements at the client level. And by the client, I mean even the bank loan officers,
Right.
so that they could in turn go to their clients and be able to explain why this is important. And it's not an easy process. There's limited comparability of like impact indicators. It's also, it's almost like you have to, almost like in the fintech space where you design prototypes and just have to keep going back to the drawing board and just keep pushing the client, right, in the same direction. But it was a huge learning curve for us as well, that change management is almost as important part of the process, right? Convincing others that this is important than the outcome. And because the outcome will follow when people believe that this is the right thing to do.
That's good. That's good. So I see Piotr is almost jumping out of his seat. He'd like to add something. So hold on, okay? But Helen, some kind of pushback you've experienced in some of these deals, something where it doesn't seem to have gone so smoothly in dealing with understanding or communication with one of the clients, something along those lines, without naming names.
So for us, I think I have two groups of clients. One is the Chinese clients, because I lead global China practice, help Chinese come abroad build their brand. And then another is American brands, European brands who like to visit in China. So for the European and the US brands, it's very easy because it's like a standard model when you build ESG activities into their marketing strategy. But for the Chinese brands, some of them, they understand it, but they don't know how to do it because they never had the practice before. So we always like to, I found the dilemma is we want to use the Western style ESG practice to implement into, to serve Chinese clients, which always receive pushback. They said, is this really necessary?
Right.
We never had that experience. Oh, we don't have budget for that.
That's right.
Or they prefer to do, so I feel that we like to do the systematic ESG activities because it's like a brand reputation. It's built through the years. It's not like an ad hoc. I always describe it like it's not a firecracker. You need to you just explode once to celebrate. Just for one project. We like to build a track for the train to move for years for your brand. So I think the good thing is, I think the Chinese clients accept that because most of Chinese clients are very open-minded, because if they want to be the multinational companies, you have to play by the rules the multinational already established successfully globally. So I think they are learning, they are trying to build more systematic system to do ESG investment. And I also think in China itself, domestically, the younger generation, especially millennium and the Gen Z, who live in the first tier city to third tier cities. China has 8-tier cities. Any city out of 8 tiers, which means the village, 1 million, 2 million people, not countable. So you think about the first 3-tier cities account for probably 40% of the population in China. The younger generations, they have this digital world. They understand a lot of things. And most of them traveled abroad when they were young, or a lot of them the middle class, their kids received education in the development countries. So it's not a new concept for them to accept. So they not only judge foreign brands, they also judge domestic brands. If they're doing the same thing for the community, and then they will do the same thing, evaluate when they make the purchasing decisions. So that's my
No, fantastic. By the way, it's not just Chinese companies that are facing up against the incremental reporting burdens, right? It's the US companies are also pushing back, and it's not helping that there's this chaos of ratings that they don't know what are the harmonized standards that they have to meet. It's like a double whammy
right,
for
right.
a lot
I
of
think
these companies.
one thing I want to add in is not only we have the big mass, acceptance from the younger generation who are the main consumers in the future, but also the government.
Right.
Government is pushing hard very much on that. For example, just last month, the CCP Central Committee and the State Council just launched a guideline on deepening the reform of the compensation, the ecological compensation mechanism to accelerate the development of ecosystem. And also we're going to build Shanghai in next 5 years to be the international hub for green financing. So both from government perspective, from people perspective.
Big ambitions, right?
Yeah. So we always set a big target.
That's right. I like it. I like it. So Yuqiang, just where have been some big challenges for you in provisioning as a bank, a big multi-service bank in this space? Any perspective from that?
Right. Thank you, Adrian. There's actually a lot. Some has been mentioned by my colleagues over here. But I do want to say, I never believe there's a medicine would be good for all the disease. But if this has to be one, I think it's basically money. So that's true. I saw a lot of questions over there already. But as a banker, I can tell you that this commitment or an investment or obstacle, what we need is money. It's not really, we don't have money. The problem is how the money will be deployed, how you gonna make it affordable, bankable, make a market deal, and then the other investor can get a return. So this is a very hard part of the, the market part that you can actually get out with your client. Well, I do want to echo Alan mentioned about the government commitment as well. So we saw the result of the G20 last week, and China made a very strong commitment. I understand that, I admire that decision because this is really crucial, especially for countries still underdeveloping. This decision is really a strong commitment. But to most of the developing countries, there's a cycle. So it's very hard to make that decision to commit with the clean development. What you need is a cost. There's a cost over there, right? We all understand you cannot easily say, okay, we're going to be there in some years. Where's the money from? So the estimated lack of the funds for the developing country to support that mission is roughly about $3 trillion. That's a rough number. It may even beyond that because there's some associated costs as well. All those money cannot rely on the government, especially for our emerging country. We cannot afford that part of the cost. What you can do is basically with the support of the financial institutions and the government, make it affordable and trying to structure it out, make it bankable. So this is the most difficult part because I've been involved in one of the UN project to evaluate the developing countries' affordability and availability on their projects. And for several years, and the recently, the only one deal done recently, ICBC has been introduced and involved as well. Why? Because it's a long process. You need to let the investor know this is worthy. You're gonna make a return, and then, well, at least the value and the culture, it's very important as well. But I'm going to correct the one thing that with Alan's side, pushback. We used to have a lot of pushback. not only in China, not only in the rest of the world, including United States. But right now, most of the cases, we don't have the pushback when we tackle the kind of the environment issue. The client normally will listen and smile and then gone. So, so they do not push back. That's a culture change. I would say it's already a pretty good progress in my view, but they still don't see the benefit of why they're going to benefit from that. So that is the mission of bank, that we need make sure our clients understand that will be bankable and will support that, and the investor will buy those bonds. So I'm holding this responsible banking with the UN program. ICBC is the actually only one Chinese bank as a funding partner together with the IFC. Definitely, we had about 30 investor. Well, I remember the discussion happened in 2018, 2019, and then right now we have 40, even close to 300 banks globally join in. So 95% of those banks already put the ESG into their strategy. So this is the progress we made, and even very hard, but steadily we're moving forward. I think that's very
I like your
important.
competitiveness. The first Chinese bank that is a signatory of the United Nations Principles for Responsible Banking. That's pretty good. I like that. And of course, this has blossomed in the 2 years since we launched that. This is, as you know, the Principles for Responsible Banking is a natural follow-on from 10 years earlier of the Principles for Responsible Investing. So Mark, you know, you talked about the importance of launching this fund, this new venture. But there must be challenges, there must be pushback, there must be some elements that you face up to that maybe you can share, you know, trying to convince somebody to co-invest with you. What are some of the challenges? It can't all be sunshine and light.
No, it's certainly not all sunshine and light. Lots of challenges. And the challenges are really up here. People have to change their mindset. They have to change their thinking. And to give you an example, a few weeks ago, we were sitting down with one of our investee companies, and we said to the president, Mr. President, I noticed that you have no women on the board. And he said, well, why should we have women? We're a manufacturing company. But then we said, what % of your workers are women? And of course, it turns out, you know, this manufacturing company, about 60 or 70% of the workers are women. So he began to think, well, yeah, maybe we should have a woman on the board of directors. So, and you know, the mindset has to be changed. Now, we can't take an aggressive approach and say, we demand that you have a woman on the board of directors. But if you take a friendly approach and an approach where we say, look, we're in this together. We want to help you, and your price, your stock price should go up so it helps us. And the way to do that is by having a diverse board of directors. Another example is we were in Brazil, and the company that we were going to invest in looked very, very good, nice business, good return on capital, et cetera, et cetera. Then we looked at the board of directors and we said, look, we noticed that all the board of directors are members of your family. He said, yes, I know it's a real problem. It's difficult for me to change that because you know how it is in a family. We can't make changes like this because I'll be disowned by my wife or whatever. So this is a chance that we finally gave away. We decided, look, we don't want to invest unless he can make these changes. And obviously he wasn't able to make this change. So you realize the psychological barriers that you have to change are definitely there. The good news is that you have a whole new generation of people coming along who are very, very aware of the importance of ESG and the importance of sustainability. So the job is getting a lot easier going forward. And I must say, generally speaking, people are quite, particularly in the small and medium-sized companies, they're quite open to suggestions as long as it's done in a friendly basis, an engaged basis. So lots of work to be done, no question about that.
But I love those two examples though, because they are very poignant. You can, every single person listening to you can easily imagine those conversations that you're having with these prospective investments as corporates. And it just brings it all to life. So we have some questions here that are coming forward. Mark, I think there were some earlier, but I almost feel like, Piotr, I want to put you on the spot because this first question is almost tied into what you were saying earlier, isn't it? So the question from William, I think it's the hardest question, one of the hardest questions of all here. What metrics do you feel best capture the spirit of ESG and impact investing? Which metrics are becoming consensus best metrics? And boy,
that's very excellent, very, very good question. And as you know, we were discussing all the different metrics that are being used to measure ESG, et cetera, et cetera. But you know, the metric that we use is the result. The degree to which ESG changes are resulting in better profitability and better growth for companies is really, to us, the best metric. That is really the end point of where we should be reaching. What is the result of what we're doing in terms of helping these companies improve themselves and thereby improve their profitability and improve their returns to shareholders, at the same time improving the environment, the social, and the governance aspects of what they're doing. So very good question, very difficult question to answer. But the good news is that we are seeing, as we heard just earlier, improvements in ESG are resulting in more profitable companies. And that's really the best metric as far as we're concerned.
There you go. There you go. So what I'm hearing from our leading light investor in this space is that you kind of know it when you see it. And maybe we don't need to be obsessive about these metrics, but you don't have that luxury, Piotr. You actually need to pay attention. You have to have a structural. So I'm going to put you on the spot here. Is that okay if I do that?
Please.
So Piotr, I think I turned it on.
Well, so my view is going to be a bit biased because, well, we have our own matrix system, and maybe, you know, I also need to go a bit more granular because, you know, we need to differentiate between, you know, matrices that are relevant for example, banking, lending, and there might be different for, you know, capital market investments. So, you know, when I look at the transaction, I need to look at each of them through the perspective of IFC's environmental and social performance standards. So we have 8 performance standards that we developed originally in 2006. We improved them in 2012, I believe, and you know, this is basically the core that you know, I need to use in assessing ENS issues associated with particular transaction, whether it's a loan or that transaction, or whether IFC's looking at taking equity. Having said that, you know, this core, it's not particularly implementable in case of capital market transactions, where, you know, as I mentioned before, it is a
like Mark's.
Yes, because, you know, to use our performance standards, you know, primarily you need to have access to the client. And Mark mentioned about engagement. And, you know, in case of a capital market transaction, you know, this is a very important portion, yes, yeah. Pre-engagement and post-engagement, but it's a slightly different concept compared to, you know, what we do and what we require our clients, where we have legally binding agreements with them that they would perform in certain way. They would follow certain type of standards. So this is something that you can't do through capital market transactions. Yes, you have prospectus. This is what would guide the deal. Yes.
Yeah.
So from my perspective, these days, I think what the EU started doing with taxonomy, it's a really good way forward. And in fact, the Chinese counterparts, the Central Bank of China,
ICBC,
I believe, came in April this year with a green catalog, which is bringing the understanding of what's good green closer to what's considered as such by Europeans. So I think there is some convergence in this space. And I see the same in smaller markets. Middle East, Egypt, they're trying to do something similar. So anyhow.
So global money is forcing it. You know what you said is something that we don't hear very often, actually, Piotr. And I know that the ratings agencies like Refinitiv and KLD and all the 600 plus different ESG ratings agencies, they don't think about the possible usage or that their metrics might be used differently for certain kinds of transactions like the banks might initiate versus the investors might initiate, right? And you can imagine how challenging that is for the corporate perspective. We're thinking about their capital structure and they don't know what's coming at them depending on which form of financing they might be trying to source, right? Fascinating. Do you want to add?
Yeah, just one line on this. I think the biggest mind shift change for corporates is to see this not from a compliance perspective, but to embed this in their operations. So I think many, like whether we're working with banks or large companies or even the smallest of, like platforms, they see this as something that they need to do, right? It's a checklist that we have to comply with whatever
Like
government standards.
They have to build a structure.
Right, or a system in place, but it's set on the side,
Yeah.
just like digitization is, right, for traditional companies.
That's right.
And part of the real challenge will be, how do you embed this, like that we're a diverse company, right? Like Mark mentioned, I mean,
Exactly.
working with, an institution where women are part of the culture. How do you work where it's diverse from like even age?
Right.
Or matrices like even the environmental and social or labor standards, right?
Yeah.
And that has to be part of the main conversation as much as business.
But what he's saying is the relative emphasis might be different depending on the type of investor that you might be trying to engage with. It's fascinating to think about. So in fact, this is actually part of what Helen was saying earlier, because she was saying, what was your metaphor? Firecracker? So it's sort of like, I gotta do something and I gotta do it quick because I need the money. And you were saying, we've got to build this as a structure. And so this actually reinforcing this concept. So I wanted to direct this question to Helen here, because she's working with advising clients. And this question from the anonymous person here is, what major components do investments in developing countries need to add to their business strategies in order to become more attractive to investors? And I assume inside the question is these ESG type investors like a Mark Mobius.
Right. I think I'm not limited to the brands. I will talk about general China in general. So I think if your country want to be attractive to investors, there are several criteria you need to meet. The first, it shows huge potential. Morgan Stanley just launched a report about the ESG financing in China in next 5 to 10 years. The total value is $16 trillion in China in 211 green financing sectors. So that's a huge potential. The second is you have the capital, right? Like Mr. Xiao said, we have the banks in China to fully support these activities. And third, you have the stable, the government support.
Right.
China is catching up in ESG. The UN PRI, the United Nations Principle for Responsible Investment, China is catching up since 2017 because in the past 7 years, China is shifting from the combat air pollution to decarbonization. So by March 2020, there's already 51 institutions, Chinese institutions signed into UNPRI, which is also leading. They are all big firm to lead the trend. The third is, I think, the capability. So China now is the #1 in renewable energy, like hydro, solar, wind power, and also leader on AI, automation, and 5G infrastructure. Yeah. So when you have this capability to realize this investment, then you are attractive. And then the last thing is we're also being very innovative to do like a green bond or the financing products. So because you need to investors outside China to have access to get investment, not directly invest in it, but indirectly from financial firms. So we are going to rolling out all these financial creative products or derivatives to publicly sell to the international market, all through the One Belt, One Road countries. Right. So with all these ingredients combined together, you sell it like a package. Yeah. Just like we're doing marketing side, we sell like a package. I think it's maybe not other emerging countries can cover all these criteria, but if you meet 1 or 2 criteria, you will attract investors into your country.
Yeah, that's great. I'd like actually Yuqiang's perspective on what Piotr just said. Have you thought about the fact that maybe the standards that you're applying to engage with clients, whether it's part of the One Belt, One Road initiative, the Asia Infrastructure Investment Bank, you guys are close partners with AIIB, whether the standards that you're applying to govern ESG, ES related metrics might be different than what others are doing?
Right, Andrew, that's a very good question, and actually I'm going to comment on that as well on top of my colleague's slide. If we lay out the key organization chart for the ESG, we knew the government is the leading role. The function including culture and guidance, including the regulation, the budget, and that's all make it affordable. That's important. And later down, there's the next level for banks. It's very important because we understand it's very hard to measure the standard of what type of the economics that may get every project. But the thing is, you have to have also consider the risk components. That what is the risk if you do not comply with those requirements or with the regulation or even the initiative. Right. So ICBC developed a model. It's as the first bank in the world. We call it a stress test for environment risk. There's content of several negative impacts, including the financial loss that you may, if you are associated with some environmental risk, project being terminated or financially punished. The second is the reputational risk that associated with the negative news that ICBC are being involved in those projects. And the last one is the social responsibility risk that we need to consider in all the kind of the portfolio that we have. So as a part of the program, we do commit in several years, we'll basically clean our portfolio. It's a very large portfolio, right? We have one where we're the largest basically in that side is for trading and as a bank. So all that seeing what is standard, Andrew, if you don't have the regulation that side, you don't consider the impact and negativity if you do not comply. It's very hard to measure only the standard to get entrance into that. So I will see combine the two parts that will make a bank or the business consider.
It's a great reminder actually, because while Helen and Mark are talking about these direct bilateral conversations that are happening between the corporates and prospective investors, you know that we have this top-down force at work here from the government. that is also sort of in the background forcing down. So Ravi, you
Yeah.
might have the last question of the hour before we go to break here, Ravi. So
Okay.
make
Well,
it a good one.
Okay,
Make it a good one.
I think it's an interesting one, and that is, there's always the question of whether ESG, like CSR, is something you sort of stick into the organization and business as usual continues, or does it actually reach the point where you can call it impact investing, which I think is a stronger term. But specifically in the Chinese context, I was very curious to see how you think, with this new emphasis on shared prosperity, that really echoes all of the ESG, but with much more seriousness, I think, than simple ESG. So what does ESG mean now in a situation where there is now a national push for shared prosperity, and you have a company like Alibaba now talking about $15 billion going into some of these social programs, which is orders of magnitude higher. So
talking about President Xi's sustainable shared prosperity concept. Do you want to give a quick reaction? And
Yeah, so very
I'm going to
quick.
close out the session here.
Sure, very quick on that. I do admire that kind of the effort, because if you look at back China 30 years ago, well, if I have to mark the largest achievement that China has made is against the poverty, right? So this bring the 600 million people from the poverty level to the right now that we had a affordable life over there. That's the most part I admire of being grow from that. So, and the second, so basically to your question, what the effort of ESG and the effort for shared prosperity, that's actually kind of the associated concept in that in saying it's created the equality to the people, create the prosperity for the future, and bring the culture and the expectation into the current social governance for the future to cure that the gap between the wealthy people and the poor people. That's critically important for the future growth.
Okay.
And will be important for the emerging market. I want to mark that.
We're going to go to break, but I'm going to each one of you, Mark, you're going to start, and you get like 15 seconds. Okay, each of you get 15 seconds because everybody's inching to go to break. And you have a bunch of young people here. They're thinking forward. Each of you has a turn here. And we want to say something to them about why this is so important, this concept of ESG, this impact investing with its overarching goals and objectives beyond just financial return, why this is so important for them to be thinking about as they plan out their future careers. Mark, you go first.
Yes, it's really about,
message.
Yeah, it's really about your future. You young people are living in the most glorious period of mankind's history. The technology that is now hitting us is just doing wonderful things. And with ESG being improved, and also the C aspect, don't forget that, we're going to have a wonderful time going forward, and you are going to benefit from this change.
Wonderful. And follow in the inspiration of those who have come before you. Momina, what would you tell these young people about planning their next stages?
Well, I think this is particularly important because you're going into the marketplace and the job place after the pandemic. And this is the first time since 1989 that there has been a reversal on poverty. So, an increase in poverty levels since 1989. So I think for your cohort, it'll be so important to be a major force in being change makers, in reversing this trend. And that obviously means looking at social challenges, whether it's inequality of healthcare, race, gender, ESG, and that you have the power to do it through commercially oriented means, like in the companies that you're in. So I guess my 15-word advice would be really see the intent of what you're trying to do, right? Like in terms of having an impact, the intent of being able to do good, but also in a very meaningful and measurable way. And that you're really then able to have that clear impact.
Perfect. Helen?
Okay, so I'll back to the brands. So if you're a consumer, buy the products from the companies who are doing great ESG jobs. And if you're future employee of these companies, push hard inside for the management to put a lot of resource into it. Thank you.
That's a very good suggestion, right? Because we all are empowered in whatever roles we play, right? Your
Right.
turn,
I have
Yuqiang.
basically two sentences. The first is for the emerging market. We may start low, but we go high.
Mhm.
Well, the second is for young generation. There's a very famous Chinese saying that, this is our word, but at the end of the day, this is your word.
That's good. They're always very wise Chinese sayings. So that's a good one. That's a good one. That's a good one. And my message to you all is listen to them. And thank you very much. I think we go to break right now. And what a great session. Thank you, Mark.